move on to the actual content today. So we have quite a bit of content to cover. Okay, so I'm going to be moving pretty fast, and we have 4 questions to do. So frankly, we might run out of time, but my focus will be on presenting the material because you guys are presented with the answers to the problems. The problems aren't that complex, so I do want to get to them, but the focus will be on making sure we get through the material in a good amount of detail. All right? So chapter 7, reporting and interpreting sales revenue, receivables, and cash. So one thing I want to point out here is there's not really any new fundamental accounting matters anymore. Everything is still in the context of journal entries. Okay? It's how do we capture this transaction in the accounting system? The complexity becomes, how do you determine the number? So it's more detail on, historically I've just given you numbers. I've said revenue is 100, it's cash or AR, that's 100, easy. We're moving away from how do you record it, because you should be very familiar with that, and towards how is the number, how is the 100 calculated or determined, okay? All right, so you might remember this, the revenue principle requires that revenues are recorded, meaning we book a journal entry only when they are earned. Okay, so what are the tests that a transaction has to meet for us to recognize revenue? We have to transfer or deliver the goods or services, right? The entity, us, ePhone, for example, retains neither continuing managerial involvement nor effective control. We don't have any say in how those assets are used, right? We know how much revenue we're going to recognize. So this is all jargon. I'll kind of put it into English for you. It is probable that economic benefits will flow to the entity. What on earth does that mean? So economic benefits in accounting speak really just refer to cash. Probable means more likely than not, which is like 50%, right? 50% will flow to the entity. So that's an interesting question. So this is sort of the focus of the whole lecture, or part of the lecture rather. If we sell to a customer who we know will never be able to pay us, what have we done? We've just given away inventory. We haven't really recognized revenue, right? If our customer is deep in debt and they haven't paid us for the last, 360 days, like a whole year, and we're still shipping them inventory and we're recognizing revenue, well, test 4 isn't really met. It is not probable. It is more likely that they're not going to pay us. And by not paying us, that means the economic benefits will not flow to us. Okay, so you'll see how we sort of account for that separately. But when you recognize revenue, the underlying principle has to be you expect to get paid, right? Most businesses aren't doing charity work, so anytime they recognize revenue, they do expect at some point in the future to collect that cash. And the costs to recognize the revenue can be reliably measured. So everyone is familiar with credit cards. Why would a company be willing to accept a credit card? Because the credit card companies, so Visa actually charges merchants quite a bit. They charge like 2.5 or 3% of the sales, and that's how Visa makes their money. So merchants aren't always that happy accepting Visa. You'll see some places have a minimum, right? Like a $5, $10 minimum spend. Some places don't accept MasterCard or American Express because sometimes they have higher fees. So why would a business accept credit cards? Well, most of us don't carry cash anymore, right? So we sort of demand that we pay with credit card. So that can increase their sales. They don't have to provide credit directly to customers. So if you have a customer who wants to buy a $2,000 MacBook and they don't have $2,000 in cash, you can put on your credit card, right? The vendor, the person, Apple gets paid by TD the $2,000. They don't care if you don't ever pay your Visa or if you're getting charged 25% interest, right? So it sort of removes the credit risk. This is no longer a thing, bad checks, but people used to be able to write checks, and then you can write a check and move the money out of the account, and then the check bounces, it's called. And there's, it's not really that relevant anymore because it doesn't happen, but if you've seen Catch Me If You Can, the movie with Leonardo DiCaprio, so that's when like check fraud was a big thing. To avoid losses due to fraudulent credit card sales, I'm not sure what that means, and then to receive payment quicker. So again, the credit card company, Visa, will pay the merchant every 30 days for all the sales made on Visa. If you're extending credit to a customer, it might take them 90 days, 120 days to pay you. So there's always benefits to accepting credit cards. Later on in the lecture, we'll see how you account for a credit card transaction if you're the vendor. And we'll give a refresher on interest. So interest is the cost of borrowing money. No surprise there. On OSAP, I think you're paying 5.5%, right? If ePhone borrowed $1,000 at a 5% interest rate, each year it pays $50 in interest to the lender. The actual rate charged by the lender depends on the borrower's credit worthiness. So if you go to a bank, so you've probably heard of the term credit score. And people with good credit scores are able to borrow at a much cheaper rate than people with bad credit scores. The reason is if you have a bad credit score, it means you have a history of delinquency, of either paying late or not paying your credit card bills or declaring bankruptcy. So if you want a bank to lend to you, they're saying, well, there's a chance you're never going to pay us. You're going to flee the country or go bankrupt, or you're going to lose your job, and we won't get our money. So to compensate for that risk, lenders will charge more money. So the same goes for companies. A company with poor cash flow, right? Banks, before they lend to you, will look at your statement of financial position, and they'll look at your operating cash flow, and it's if it's been negative for the last 2 years, and you're only financing your operations, if you look at the financing activity section, by taking on more debt, the bank might not be willing to lend to you. You don't have very good cash flow, right? Maybe a history of bankruptcy. Maybe this company has declared bankruptcy. They're going to be charged a very high rate of interest, 10 to 15% per year. If you have strong cash flow, tangible assets, if you have a land and building with no mortgage on it, you can borrow against, right? That's low risk. Even if the company goes under, the land is still there. The bank can take the land or the building. So that's how banks determine if you're 10 to 15% or if you're 3%. Interest is an expense. You'll always see interest expense in the statement of operations. It's not an asset because a payment of interest does not lead to a future benefit. Right? Interest only arises over time as we continue to borrow the money. Okay, so business-to-business sales. Companies will often allow customers to purchase merchandise on account. Again, this is your account receivable, account payable. This is stuff we covered, I think, in the first lecture. Nothing new here. And it's called on account. Okay. The customer promises to pay in the future. Nothing revolutionary here. Okay, so this is something we haven't seen before. Sales discounts. When customers purchase on account, they may be offered a sales discount to encourage early payment. So companies always prefer having cash in their pockets instead of waiting to receive cash from their customers. So they say, we'll sell you this piece of equipment. If you pay us early, we'll give you a little bit of a discount. So these are standard terms. Okay. This is called 210 net 30. This means you get 2% off of your purchase if you pay within 10 days. Otherwise, you owe the total, the net, in 30 days, maximum days in credit period. So regardless, you have to pay your bill in 30 days. If you bought a piece of equipment, the vendor says you have to pay the full amount, $1,000, in 30 days. But if you pay us within 10 days, you only need to pay us $980. Okay, so they give you a bit of a discount as an incentive to pay. Right? Now, you might be thinking, okay, 2%, like not a very big deal. So this just shows with discount terms of 210 net 30, a customer saves $2 on a $100 purchase by paying on the 10th day instead of on the 30th day. Okay, so again, $2 is not that much. That's like a coffee on $100. But 2% on $1 million is quite a bit, right? That's 20,000. The other thing to look at is the interest rate. So let's just go back here. Oh, sorry. So the bank might charge anywhere from 3% per year to 10 to 15% per year, right? Interest is always stated on an annual basis. Your savings account might be paying you 1/4% or 0.5% per year, basically nothing, right? You're actually earning 2%, but in 10 days, not in a year. So if you calculate the amount of interest income that you're earning by paying this early, it's 37.2% per year. Okay, and this is if you were to make a purchase every 10 days and then take this 2% discount. So a 37% rate of interest is pretty high. That's pretty good. Said another way, if you don't take this discount, if you have a choice between paying $98 or paying $100 and you choose to delay and pay the $100 every time, you're actually being charged effectively a rate of interest of 37%. Well, that's stupid. You could borrow from the bank for 3% and pay off all of your accounts payable at anywhere from 3 to 15%. You're still better off that way. So it's actually a good idea to take these sales discounts. All right, sales returns and allowances. So everybody should be familiar with these. This is where you return something, right? You buy a shirt and you don't like it. You buy something and it turns out it was broken in shipping, so you have to send it back, right? So the returns and allowances are recorded in a contra revenue account, XR. Okay, does that have a debit or a credit balance? It's going to be a debit balance, right? Because it offsets revenue, which is a credit balance. So all of these things, companies record 1, credit card discounts, 2, sales discounts, and 3, sales returns and allowances separately to allow management to monitor these transactions. Notice how these are separate from sales revenue. We still record sales revenue on what's called a gross basis or a 100% basis. When a customer returns something, we don't reverse the original transaction to recognize the revenue. We don't debit revenue. In fact, we debit sales returns and allowances. When a customer takes the sales discount, we don't debit sales revenue, we debit the sales discount. This way we can keep track of the numbers separately. Okay, so that will get us from sales revenue to something called net sales. Sales revenue is gross. Okay, and then we have these adjustments to it to get to net sales. And this is important because you might see maybe there's a lot of sales returns and allowances, right? Maybe there's a lot of sales discounts. Maybe there's a lot of credit card discounts. But this can help you analyze, well, if people are constantly returning our goods, why is that? Are we shipping everything broken? Are we pushing them too much in the store, they're buying it, and then they're coming back and returning it? Maybe credit card, maybe we're getting charged too much by our credit card company. Maybe we should switch to only accept a different type of credit card, right? So it helps you analyze. Instead of just having one lumped in number in sales revenue where you don't really know what's going into it, here we break out all of the accounts. All right, gross profit. So gross profit is just your nets, so net sales, right, this, minus cost of goods sold, the inventory, the value of the inventory that was sold to recognize that revenue. So your gross profit percentage is just the gross profit as a function of net sales, okay? And that just gives a sense of, for every dollar of net sales, how much are we really earning? Because if it costs us $1.20 in inventory to make a sale for $1, we're actually losing money every sale, right? In this case, we're profitable, 20.3%. So all we're saying is gross profit is 20.3% of net sales, which means cost of goods sold is 80% of net sales. And so this just gives a sense of how costly is our inventory. Hanes Brands has a very high gross profit. Delta Apparel has a lower gross profit. So either their cost of sales is too high, or their selling price is too low, or it's a mix of both. All right, I've actually got this question a couple of times as to the difference between accounts receivable and notes receivable. Notes receivable are often longer term. Okay, accounts receivable are usually shorter term. Even though the definitions here are separate, we consider these the same. Okay, AR and trade receivables are the same thing. Okay, a non-trade receivable are amounts owed to the business for other than normal business transactions. So that might be if we had sold land and we're not in the business of selling land, and the purchaser promised to pay us, in the future they might have given us a note or a non-trade receivable. But again, nothing to do with our operations. So here's an example legally as to how a note might look. So all it does is specify the amount, how long, the interest rate. The other thing to note, notes receivable often have interest. Okay, a specified rate of interest. AR usually does not have interest. Okay, we don't usually charge 30 or 60 days worth of interest on accounts receivable. On notes we do. Okay, so bad debt, this is an important topic. It will be tested on the midterm, and I'm telling you guys that because you all made it out here today, even though it's the middle of your midterm season. So bad debt will be tested, so it's important. So let's just take a step back. In theory, businesses would always want to collect 100% of the sales they make, right? If you're selling to Walmart, you expect Walmart to pay you in full. Okay. You would never make a sale to someone or to a company that you know won't be able to pay you. If you know they're declaring bankruptcy tomorrow, you're not going to send them any inventory, right? Because they're just going to take it, or you're never going to see that money, right? So when the sale is made, at the time the sale is made, the expectation is that we will get paid in full. But you know from experience that businesses go under, they fail to pay, sometimes there's fraud, sometimes there's very, very long delays in payment. So businesses need to make an estimate, this is an accounting estimate, for what's called bad debt. And that is results from credit customers who will not pay the amount they owe, regardless of collection efforts. So there's a lot of effort that goes into collecting older accounts. You might call them, you can send collection companies after them, you can send them, you can take them to court to pay you. There's a lot you can do. The problem is, all of that, all these collection efforts, okay, and kind of figuring out that your customer has gone bankrupt and won't pay you takes a very long time. And you'll remember that the matching process wants to match the expenses with the revenues, okay? So we need to record an estimate for the amount of revenue that we actually will never collect, or we expect to never collect, even though we don't know what the amount is today. If we could look in the future and say we know that customer 1 out of our 100 customers is not going to pay us, they're going to go bankrupt tomorrow, well, first of all, we would never sell to them. But second of all, then we could recognize with accuracy the bad debt related to that account. The problem is we have to record an estimate because we can't wait for the transaction to transpire in the future due to the matching principle. The matching principle says when we recognize the revenue, or throughout the year, let's say the year ended December 31st, 2016, we've recognized $100,000 worth of revenue, we also have to account for the fact that we know that maybe 2 or 3% of our customers are going to go bankrupt or not pay us, take the money and run, whatever it is. Okay, but we don't know which customers because we wouldn't sell to them in the first place. So it's almost like a forward-looking estimate. So most businesses record an estimate of the bad debt expense with an adjusting entry. You know what adjusting entries are. We make them as at December 31st or the fiscal year end. No external transaction has occurred, but we know that either time has passed, so we have to remove some of our deferred revenues or our prepaid expenses, or in this case, we have to make an estimate for bad debt. Okay, so, and again, bad debt only refers to credit customers. If Walmart paid us in cash, then there's no more receivable from them. There's no risk that they won't pay us because they paid us already, right? We have the money. So it's for customers who still owe us money at the end of the year. So when we record a bad debt, what we're effectively doing is reducing accounts receivable, okay? Since it's expected that we won't be collecting that account receivable. However, the reduction to accounts receivable occurs through a contra asset account named allowance for doubtful accounts, shortened to AFDA. That's how I'm going to say it from now on, because allowance for doubtful accounts is a mouthful. AFDA has a credit balance and offsets accounts receivable. Okay, the same way that accumulated depreciation is a contra asset. It has a credit balance and it offsets property, plant, and equipment. AFDA has a credit balance and it offsets the account receivable balance. Okay, bad debt also reduces net earnings because it is an expense account. We do not debit revenue directly. We debit the bad debt expense. Okay. And we'll see how that looks. Now, if we take accounts receivable and we subtract AFDA, that is called net realizable value, or NRV. So if AR is stated on a net realizable value basis, you know it's stated net of the AFDA. Okay, so here is an example of how a bad debt journal entry looks. So Decker's estimated a bad debt expense for 2015 to be $27.6 million. So we're going to get to how they calculated that number, but let's say they know from past experience about $27.6 million of their sales they're actually never going to collect. So how do we record the entry? We'll debit this bad debt expense, right? The expense is increasing. Credit the contra asset, AFDA. So in substance, what we're doing, you can think of it as reducing net earnings and reducing AR. That's the end goal here, ultimately, once all the numbers flow through. But we don't reverse the original transaction. Let's say this is from one customer. Let's say we sold goods to a customer for $27.6 million and we decided they're never going to pay us. Rather than saying debit revenue, credit AR, and reversing that transaction and assuming it never happened, okay, the end result would actually be the exact same. We would have lower net earnings of 27.6 million, and we'd have lower AR, or assets, of 27.6 million, right? We're getting the same effect, but we're breaking out the bad debt into separate accounts so that we can analyze it separately, right? You might want to know if a company has 10% bad debt and every other company has 1%, you might think something's wrong with our company. Why are we giving credit to these customers who are going bankrupt, right? So we use these accounts just to keep track of the bad debt, but the end impact is still the same. All we want to do is effectively get rid of that impact of the transaction that had originally occurred, making that sale to that customer who went bankrupt. We just do it in a different way. We don't directly just reverse the other entry and say, let's debit revenue, credit AR, assume it never happened, right? Disclosure in the statement of financial position, trade receivables or accounts receivable less AFDA is called the net realizable value, NRV. And that's the amount that we actually expect to collect, which makes sense, right? As shareholders, we want to know, even if ePhone said, oh, we made $100,000 of sales, we might say, great. And then next year we only collect 80 grand of it, and they say, oh, by the way, we only expected to collect 80 grand of it. We would say, well, we would have liked to have known that last year, right, when you gave us the financial statements. So it's important to know the net realizable value, and this is disclosed in the financial statements. This is it's a real thing. You'll often see AR stated on an NRV basis, and there will be a note. Remember we discussed notes last week? You'll go to the notes to the financial statements, and it'll show gross AR less allowance for doubtful accounts and then NRV. Okay, so we've seen the journal entries. We've introduced 2 new accounts, but it's still just journal entries. It's just you're debiting an expense, you're crediting a contra asset. Nothing new. Same entry as depreciation in theory, right? The question is, how do we get to the number? We have to make an estimate. Now this is different than what we've seen up till now because we haven't had to really make any judgment calls or estimates. In all the numbers we've seen, everything has been factual. We've been given the numbers, but also it's been like, you bought a piece of equipment for $1,000. You paid $1,000 in cash. There's an invoice that says it's cost $1,000. There's no argument that you paid $1,000 for it, right? When you sell to a customer, an iPhone will cost you whatever, $600. You go to the Apple store, you pay them $600, and you get the iPhone. There's no real estimate in that number. Okay, the problem with bad debt is we don't exactly know which of our customers will default and for how much. Okay, so we have to make an estimate. Accounting, as you become more experienced in accounting, what you find is more and more of the numbers are actually estimates. There's not as much fact as one would think. Even though we're dealing with numbers, it's still very much subject to judgment. So it's expected that the company will not collect $27.6 million, except none of its customers have defaulted on payment yet. So again, we use the matching principle for this. Because we're recognizing revenue, we have to recognize the expense. So how do we come up with the $27.6 million, or how did this company come up with the $27.6 million? Well, historically, they know that 5% of their customers default, which might form the basis of the $27.6 million estimate. So they might look at a listing of all of their credit customers outstanding at year end and say, well, the total amount of credit that we've extended is 20 times whatever 27.6 million is, 540 million something, and say, well, we know that typically 5% of these customers will default. Same way that with statistics, that's how life insurance works. They know that every year 1% of the population dies. It's very hard to say which person will die. It's very easy to say we know 1% of people will die when you have a large enough sample. So same goes for this. It's easy to say we know every year 5% of our customers default. We can't say which specifically. Okay. The company has not yet identified a specific customer. Okay. So, all right, so let's think of December 31st, 2016. They book this bad debt expense. Debit bad debt expense, credit AFDA. So we're now consistent with the matching principle. We've recognized an expense. We've reduced net earnings. We've reduced assets. We're being conservative maybe. We still don't know who's going to default, okay? Let's fast forward 6 months. Now we know which of our customers are delinquent in paying us, which have gone bankrupt, which have fled the country, whatever it is, okay? And now we say customer number 2 has now been identified as being uncollectible, okay? So now we write off the bad debt, and this is a different entry. Okay, what we do is we actually reduce AFDA and reduce accounts receivable. Okay, and we're going to see an example of that. But this is a separate journal entry. So there's 2 journal entries. The first is to recognize the bad debt expense, even though we don't know who is going to default. The second, once we know who is defaulted, we now reverse the allowance for doubtful accounts, and we remove the account receivable. So I'll show you how that looks. This is a Seinfeld clip. I can't get the sound working for my laptop, but it's like 20 seconds long. I highly recommend you guys check it out. It's really funny. Notice that the recognition of the bad debt expense occurs in a different period from the write-off, okay? So let me show you how the write-off looks. So when it's clear that a specific customer's account receivable will be uncollectible, that amount is removed from the trade receivable. Okay. So Decor's write-offs were 25,216 in 2015, 25.2 million. So look at this journal entry. What we're doing is we're debiting AFDA, so we're reducing AFDA. It was brought up, okay, we're bringing it down, AFDA, and we're crediting trade receivable. These are both, this is an asset, this is a contra asset. There's no impact to the statement of income, right? There's no expense, there's no revenue here. All we're doing is, we don't want to be carrying, if this was Walmart, for example, and Walmart went bankrupt, we don't want to be showing trade receivable for Walmart 25 million, and then have that allowance to contra it for 25 million. Well, what we say is, well, let's just offset them, right? Because we know Walmart's never going to pay us. So here's the interesting thing. So assume that before the write-off, Decor's trade receivable balance was 144.1 million, and the allowance for doubtful accounts was 35.9 million. So before the write-off, we have receivables of 144, less AFDA of 35.9. Our NRV was 108 million. We expected to collect $108.1 million from our customers. After the write-off, our trade receivables goes down because we are, if you look at the entry, we credit trade receivables, right? And we debit AFDA. So trade receivables has gone down to 118.8 million. AFDA has gone down to 10.7 million, but our NRV is the same. Okay, the write-offs do not change the NRV, nor do they affect the statement of earnings accounts. So that's what we actually want to achieve with this. With the matching principle, we wanted to have recognized all of those movements in earnings and assets. At the same time, we recognize the revenue. At this point, all we're doing is just breaking out the amounts of uncollectible accounts for the knowledge of the users of the financial statements, but there's no impact to our earnings, right? So again, the 2 entries, I want you to notice the difference. The bad debt expense will be made at year end, and it actually impacts the earnings because we increase expense, and it increases the assets because we effectively, through increasing a contra asset, we're crediting the asset side of the balance sheet, and we're reducing the assets. The write-off occurs whenever we decide or we realize that a customer won't pay us, but there's no net impact to assets or even to the NRV of the AR. And there's no impact to the statement of earnings. But again, this write-off will be occurring after we've booked that bad debt expense. That's the point. The point is that we're recognizing some bad debt expense at year end to show the users of the financial statements that, hey, we're not going to collect all of the AR. Here's an estimate of what we don't think we'll collect. And then next year they sort of true it up. They say, then they start writing off accounts as they become uncollectible. Okay, so again, we still haven't got to, well, how do we determine, these are just the mechanics, but how did we get to this number? Right, so I said, okay, well, maybe they took 5% of their credit sales. That's one method, but I'll show you there's two methods they use. One is called the aging of trade receivables method, and the second is called the percentage of credit sales method. Okay, so we're going to start with the aging of trade receivables method. Okay, so the focus of this method, the methodology is we determine the desired or expected balance of AFDA. And how we do that is each customer's account is aged, quote unquote. Breaking down the balance by days and number, showing the age and number of days of each part of the balance. Okay? And the logic here is older accounts are less likely to pay. Let me show you how that looks. And I'll go back to that other slide in a minute. So here's a list of all our customers. Okay, in this case it's individuals, but it could be companies, right, that we're extending credit to. And so we have categories. One is not yet due. That means we'll call this 0 to 30 days. Then we have days past due. Remember in the beginning, we said that sale terms are typically 210 net 30. Net 30 means you have to pay the full balance in 30 days. Otherwise, we consider your balance delinquent. Okay? So any customer, so in this case, our Aaron, his balance is anywhere from 1 day past due, so 31 days, to 30 days past due, so 61 days. And he owes $235. You can go all the way to over 90 days. And we sort of just group everything older than 90 days into one category. But you can pick any specification you want. You can do a specific stratification for every day, right? So in this case, T. Baxter also falls in this category. Okay. J. Clark has 3 different transactions in different categories, right? So over 120 days ago, we made a sale to J. Clark for $500 and they haven't yet paid us. We made another sale 91 to 120 days ago for $200, and we made another sale to them 61 to 90 days ago for $50, and they haven't paid any of these amounts. Okay, but what we do is we bucket each of these by the age, so not by the customer, right? We don't care about customer identification at this point. All we care about is the age of the AR, and we total this up and we say, so our total AR balance is 10.66 million or thousand, and that will show up on the statement of financial position. What we've done is we've stratified that. So 3,500 of it is not yet due. 2,500 of it is 1 to 30 days old, and you can see the rest, okay? And then we make an estimate. This here is the estimate. We have to look at our historical records and make a judgment call about what is the likelihood that we will never collect some of these balances. And we know from past experience that if a customer hasn't paid us for over 90 days, we know that there's a 40% chance we'll never collect it. If a customer hasn't paid us for 61 to 90 days overdue, there's a 25% chance we won't collect it. And then 10% and 4% and 1%. Okay. So, what we do here is we determine the ending balance of AFDA. Okay, and so what we need to know is the age and amount of all of the AR, okay, which we have here. So we know how old each of these accounts are, and we have the balances, and we have an estimate of what is the likelihood that they won't pay. Okay, but because we're determining the ending balance, we need to know the opening balance, so we can determine the difference. And that difference is bad debt expense. These percentages here, 1%, 4%, 10, 25, and 40%, are multiplied by the appropriate column total. So that means we take 1% of 3,500, 4% of 2,550, 10% of 1,830, 25% of 1,540, and 40% of 1,240. And that is what we estimate will be uncollectible, which makes sense, right? Historically, we know that 25% of 61 to 90 past due amounts are never paid. So we can estimate, well, we think that 25% of the current amount will never be paid. So that's our allowance for doubtful accounts. Okay, so they've done the math here. They've multiplied all these numbers out, right? So these are all multiplied. And then you get a total, 1201. So what we're saying here is we expect the allowance for doubtful accounts to be 1201. Yeah, so that those are given, yeah. I mean, in this case, notice how it goes from like A, B, C all the way to Z. So there's sort of like missing accounts in there, but you'll be given the totals. Or you'll be given, yeah, you'll be given the totals by days past due. All right, so we know that our AFDA should be 1201 based on looking at how old our AR is and our past experience with this AR. Now this is why it's an estimate. It's very possible that this over 90 days, these balances will never be collected. It's possible that we'll collect 80% of them, right? This is just historical experience. So the question says, record the December 31st, 2015 adjusting entry, assuming that the current AFDA balance is $50 of credit. So how do we decide, how do we determine this 1151? Well, we know that the year-end balance has to be 1201, and we know that the current balance is 50. Therefore, our adjusting entry is the difference. Let me show you the T account. The T account will help you think about this much more clearly. You know 1201. You know the 50. This is your X. So you just solve for it. Here's our journal entry again. We recognize debit bad debt expense, credit AFDA. That's the first method, aging. And now you should understand what the name means, aging of trade receivables. We look at how old they are, right? And that drives the rest of the analysis. There's another way to go about this, and it doesn't look at the, it's a simpler method, okay? Fundamentally, it's trying to do the same thing. It just doesn't use as granular information. So in the percentage of credit sales method, the bad debt percentage is based on the actual uncollectible accounts from prior year's credit sales. Okay. And in this case, rather than first calculating AFDA and then plugging bad debt expense, we calculate bad debt expense directly. And all we do here is net credit sales times some bad debt percentage. And this is also an estimate. Because this is based on actual uncollectible from last year. But who knows if this year will be the same as last year. So in this case, in 2015, Kids Clothes had credit sales of 600 grand. Past experience indicates that bad debts are typically 1% of sales. So bad debt expense, very simply, is 600 grand times 1%, that's 6,000. Then we recognize bad debt expense and the allowance for doubtful accounts. Okay, these are two methods, and they're both valid, but they'll give you different results. So what I'll say is, you will need to know how to calculate bad debt under both methods for the midterm. Okay, so you'll need to know the percentage of credit sales method and the aging of receivables method. So study this. I think a lot of people got, so last year this was on the final instead of the midterm, given how the timing worked, but a lot of people got it wrong. And I was surprised because I thought it was pretty straightforward. The question is asked very simply, you're given all the information, so I recommend studying both of those methods and being comfortable with the journal entries and how to get the amount of AFDA versus bad debt expense. Okay, so this is an interesting ratio. It's called the receivables turnover. And it's your net sales divided by your average net trade receivables. And this ratio measures how many times average receivables are collected and recorded for the year. Recorded and collected for the year. Okay, so let me walk you through an example to try to conceptually understand what's really happening. So this company, Gildan, reported net sales of 1.948 million. And it says at the end of last year, receivables were 191,000. At the end of this year, they're 260,000. So our average trade receivables is somewhere in between there, 225,000. Okay. So imagine that all of our sales were on credit. Okay. And imagine we only had one customer. And imagine we sold to that customer in $225,000 increments. So how does that journal entry look when we make the sale? Debit AR, 225,000, credit revenue, 225,000. Then we collect the cash, debit cash, credit AR, 225,000. And then we make another sale to that same customer, 225,000, right? So the AR balance is effectively going from 0 to 225 to 0 to 225, okay? But our revenue is accumulating, right? Because revenue is not point in time, revenue is over time. What this is saying is, if we had total sales of 1.948 million, and our average AR was 225, we went through that process of selling to the customer and then collecting all of that 8.62 times. This is simple in that we only have one customer, right? In actuality, you have a lot of customers, okay? But if we only had one, all that's happening is we sold to one customer 8.62 times at an average sale price of 225,000. Now notice how at the end of the year, our trade receivables are only 260, right? Your trade receivables are not going to be 100 or 1.948 million unless you made one gigantic sale at the end of the year, right? You make sales throughout the year. The thing is, AR gets collected, right? AR sort of fluctuates, it flows. So you can compare to other companies, right? And I'll give you another way to think about this that might help clear it up. Okay. You can look at the average collection period. So if you know that 8.6 times throughout the year, we sold to a customer and then collected the cash, and then sold to the customer and then collected the cash. If you take that ratio and say, well, there's 365 days in a year, and we collected 8.6 times, that means on average, our accounts receivable were outstanding for 42.3 days. So the relationship between the 8.62 and the 42.3, this is not days, this is just a unitless ratio, right? But this 365 days, this is in 1 year, okay? If we were to go back, Hanes Brands, because they have higher receivables turnover, 9.45, if you were to take, I'm not sure why this is staying there, but if you were to take 365 over 9, you're going to get a lower number. Meaning they're collecting in fewer days, meaning they're maybe more aggressive in their collection policy. Right? So all this is meant to get a sense of the cycle of when we sell to a customer, how long does it take us to collect, and how frequently do we go through that cycle? In theory, if we had sales of 1948 and our year-end AR was 1948, that's a problem, right? That means either we're selling to customers who have never paid us, or we just booked one big sale at the end of the year, right? Your receivables turnover is going to be like 1, which is very, very low. Okay, switching gears a little bit, internal controls. So this is kind of a formal definition, but we'll give you some more practical examples. You all know what these are, even if you don't think you do. So internal controls are processes by which the company's board of directors, management, and other personnel provide reasonable assurance regarding the reliability. Remember, we care about the financial statements being reliable. We don't want people lying. We don't want there to be errors, right? We want the numbers to be accurate. Of the company's financial reporting, the effectiveness and efficiency of its operations, and its compliance with applicable laws and regulations. So there's actually, we're not saying anything new here. In general, if you're running a company, you want to make sure that people aren't stealing money, that you're not accidentally breaking the law, and that you're recording all of these transactions accurately, right? These are things you want to do as a business. So the question is, well, how do you actually do those things? So these are called internal controls. Okay, so here are some examples. Control, gate at the parking lot only opens after payment is made. This prevents drivers from parking their vehicles without paying. So if you own the parking lot, this would fall maybe not under the financial reporting category, but maybe efficiency of its operations and effectiveness. Control, ticket scanner, the ACC only lets you in after your ticket is scanned. Well, that makes sense. You don't want people without tickets walking in or with fake tickets walking in, right? Again, like this is, I mean, it's kind of so basic that you already know it. It's hard to kind of conceptualize it, but if you own the ACC, you care about only letting people in who have tickets. The clerk at the LCBO checks your ID to ensure age. The LCBO cares about laws and regulations, right? Again, it prevents underage students from buying alcohol. So all of these are examples of actual internal controls that exist at companies. Okay, but these are more operational in nature. You can think that from a financial reporting perspective, if you're an accountant, you care just as much about if the company has really good controls over how it records transactions. And the reason the internal controls are so important is because all the examples we've seen up until now have been individual transactions, one transaction at a time. It's pretty obvious what it is. If you're Google, you have millions and millions and millions of transactions. It's actually physically impossible to audit all of the transactions. So as an auditor, you actually go and test the internal controls to make sure that the controls are functioning as intended So you might test a few sample transactions, run them through the control process and say, okay, from start to finish, the transaction is being recorded correctly in the financial statements. And then you want to make sure that the control is accurate and captures all possible instances of that transaction. Because you can't check every single transaction. It's physically impossible. Okay, so what are some controls over trade receivables? So the first thing you want to think about is what could go wrong with trade receivables? Well, the worst case is extending credit to non-worthy customers. You want to minimize bad debt. So what are some examples of controls that might be in place at a business? And these actually exist. This happens in the real world. What are some examples of controls that might be in place to prevent a company from extending credit to a customer who might not pay them? Require approval of a customer's credit history by a person independent of the sales and collection functions. So maybe the manager of inventory needs to approve extending credit over a certain amount, let's say $1,000. And so they might look at the history of that customer and say, and so here's, let me bring you back a few slides, I'll show you a good example. J. Clark, okay, 3 separate transactions whereby, so he already owed us $500 that were over 90 days, but we still made another sale to him for $200. Maybe we shouldn't have made this sale to him. If there was someone overlooking this process, someone independent, they might say, well, wait a minute, why are you giving J. Clark more credit? Why are you sending him inventory when he's not paying us? He already owes us $700 that are quite old. Okay? The reason why it's important to have an independent person is because there's bias and incentive, right? If you are the, here let's see, independent of the sales and collections function. If you are a salesperson, how do you get paid? Commission based on the amount of sales you make. You just want to book the largest possible sales number you can, regardless of if the customer is going to pay or not, right? So someone independent has to step in who doesn't have any incentive to extend credit and assess if this person is worthy or not. Monitor the age of trade receivables periodically and contact customers with overdue payments. Again, it's not neuroscience. It's you, every 2 weeks you look at the list and say, here's a customer who's 60 days over. Let's call them, let's send them a letter, let's see what's happening, why they aren't paying us, right? And there's incentives. You can reward sales and collection personnel for speedy collections. So these are just some examples, by no means an exhaustive or comprehensive list. All right, so cash. Internal control of cash. So cash, as you can imagine, is the asset most susceptible to theft and fraud, right? Because it's really easy to just put in your pocket. So you want to properly account for cash. You want to make sure that your books are accurate. You want to safeguard it. You want to make sure it can't be stolen. And actually, so this refers to all assets, okay, not just cash, but then cash is the specific example down here. Ensure accuracy of financial records. Now, I'm not sure why they separate properly account for assets and ensure accuracy of financial records. I consider those to be almost the same. But what you care about is you're recording it correctly and no one can steal it, right? Fundamentally, if you own a jewelry store, you don't want your employees walking out with diamonds, right? So, how do you ensure that these assets are safeguarded? So actually, so here's the thing, accounting fraud, did I tell you guys my accounting fraud story yet? Maybe I told it to someone else. So when I was an auditor, so first of all, fraud is rare. It doesn't happen because of good internal controls, not because everybody's honest. It happens because internal controls are in many places very, very good. It's not possible to steal cash. So a buddy of mine worked in a casino. He was the guy who spun the roulette wheel. And there's cameras everywhere in casinos, as you know. And he said, anytime you touch a chip, you have to like stop, turn your hands over so the camera can see, and you can't wear long sleeves. And so you have to go like this every time you touch a chip. That's so that employees can't steal the chips, right? He says it's almost impossible to steal money from a casino. That's why. because there's a ton of cameras. They're very vigilant with their safeguarding of assets. They take it very seriously. If you don't show your hands, you'll get fired after 2 or 3 incidents, even if you're not actually stealing anything. So fraud's rare because internal controls are so good, but once in a while it happens. And it's almost always because the internal controls broke down. So an example of this is I was an auditor, and luckily this wasn't on the company I was looking at. It was a company that owned a lot of real estate. So we were auditing one of their subsidiaries, and there was another subsidiary, okay? So there's an AP clerk, an accounts payable clerk, and so the accounts payable clerk would get bank statements, like from RBC or whatever, they'd be mailed, and she would be the one, she would also be the one writing checks to pay suppliers, okay? So the business at the time had in place the control that all checks over a certain amount had to be signed by the CFO. So usually smaller checks, if it's, let's say, under $2,000, it can just be printed by the AP clerk and sent away, for payment, and there's no control because you don't want the CFO spending 10 hours a day signing checks, right? The CFO was the founder of the company, and he was like 85 years old, and he insisted on working, but he wasn't really all there. And the AP clerk was young, and she had like a couple kids, and so she needed money. AP clerks don't get paid that much. And for years, what she was doing was writing checks, actual checks to suppliers, but she would also put in a check in her name for $5,000, $10,000, and put it in the stack of checks to go to the CFO for signature, and he would just sign them all. And she was doing this for years. And the problem was, she was also the one receiving the bank statements. So no one really saw that the money was going out the door, right? Because she was getting the bank statement and seeing a check to herself for $5,000 and obviously not telling anybody about it. She was recording it in the accounting system as payment to one of their suppliers, payment for rent or payment for utilities or something, right? The way she got found out was they hired a new controller. And so the controller is like the head accountant who kind of works under the CFO. And so the AP clerk was away on vacation, so the bank statement went to the controller, and the controller gets a bank statement. It's very odd to see checks in the name of your AP clerk, cash for even amounts, for $5,000 or $10,000. So she brought it to the attention of the owners of the company, and right away they're like, no, she's not, like, there's no reason for her to be getting that money. Lo and behold, she was stealing it. They estimate that she stole $2 million over the course of 10 years. But this stuff happens in real life. And this is small fraud. $2 million is nothing for some of these big companies. That's the thing. So it was owned by a very wealthy family. They didn't even notice that $2 million was missing because when you have that much money and property, it's like, it's all just numbers to them, right? So this happens. So where did they go wrong? I mean, in theory, the AP clerk should have been more ethical and should have realized what she was doing. But once you started getting away with it for 10 years, you realize you think it's never going to happen. But the internal control was, well, there's two. One was the CFO shouldn't have been signing checks. There should have been someone else signing checks as well. Sometimes there's dual sign-off, it's called, for checks. And the second is the AP clerk should not have been getting the bank statements. Someone else, the controller, should have been getting the bank statements. Because even if the AP clerk could get the check by the CFO and signed, as soon as the controller sees a check going out to the AP clerk for $5,000, you know something's wrong, right? And you start investigating and seeing how that was recorded in the accounting records. So that is called separation of duties. Okay, recording who actually books the journal entry into the accounting system. Custody. Now, custody is important for physical cash, but also checks. Who has control over the printing of checks? The way checks work these days is they're usually printed just from a company's printer automatically. So who has the authorization to actually print a check? Or who has physical control over the cash? If you're a cashier at the Value Mart, you have custody over that cash, right? And the third is authorization. Who authorizes checks or online payments? And if you separate these duties, it becomes very hard to steal cash. Even if you can get someone else to kind of go in with you on this fraud, if you are now separating the 3 duties, it's extraordinarily risky, and it just doesn't happen anymore because it's really hard to get 3 people to perpetuate a fraud like this for an extended period of time. And actually, vacations are mandatory for people in key positions for this exact reason. They say you have to take 2 weeks off because the system should function on its own. Usually the problem with these frauds is it forms like an intricate web, and the AR clerk or the AP clerk stops taking vacation because they have to be there every day to handle the cash that's coming in and going out and the journal entries. And they'll refuse to take vacation, and lo and behold, if they're forced to take 2 weeks off, the fraud unravels very quickly because someone else has to take over the duties, and they say, well, this doesn't make sense that there's a $5,000 check going out to the AP clerk, and then all of a sudden it gets uncovered. So it happens very infrequently these days, especially with cash, because there's so many controls over who has access to what. Okay, so here's an example of a cash control. Or here are some examples. We're actually going to discuss the bank reconciliations. Okay. Payment approval. Before a check goes out the door, the CFO has to approve it. Pre-numbered checks. If you guys have a checkbook, you might have noticed that the checks go in order, 1, 2, 3, 4, 5, etc. And that's because the system will record the last check you paid was check 6. The next check you would expect to see come out would be check 7. If you see check 6 and then check 8, you wonder what happened to check 7. It's possible you sent it to someone and they haven't cashed it, but it's possible someone stole it. Check signatures, of course, dual sign-off is pretty standard for checks over a certain amount. Okay, so what is a bank reconciliation? So every month you receive a bank statement, either in paper or online. You can view it. And of course, it just shows your beginning balance. Here's all the deposits. Here's all the withdrawals. And here's your ending balance. Right? Very simple stuff. The thing is, the balance on the bank statement might not agree to the balance in our books or our accounting records. And that's not because either of us are wrong. It's just because the bank sometimes has information that we don't, and we sometimes have information that the bank doesn't. So we'll show you how that looks. So the purpose of the bank reconciliation is to account for all those differences, to get to the correct amount of cash. Ultimately, we want to answer the question, why is book different from bank? Okay, so there is a true correct cash balance, right? There is an amount of cash that ePhone has. Okay, let's start with the balance per bank. So let's say the bank statement shows $100 as at December 31st. Let's say deposits in transit. Let's say I have a bunch of checks sitting on my desk that I forgot to deposit. The bank doesn't know about those, right? Thing is, when I receive the check, the journal entry, that's when we debit cash and credit AR, when we get the check in the mail. So all of a sudden, our books are going to show a higher amount of cash, but the bank doesn't know that I have a check physically sitting on my desk, right? The same goes for an outstanding check, and that refers to checks that we've written to pay our vendors that might still be in the mail. So when we write that check and pay the vendor, we consider that cash out the door, right? As soon as the check is mailed, we're going to credit cash, debit AP. The bank only knows that we've written the check when it's been cashed by the person who's received it, right? When your landlord cashes their rent check every month, you see the cash come out. You might consider yourself to be, 6 months poorer than you actually are because you know there's 6 months of rent sitting there, right? The bank doesn't know that you have checks outstanding, right? Sometimes there are bank errors. This happens. Sometimes you'll see in the news people wake up and they see like a $20,000 credit to their account, and then the bank reverses it because they said, oh, sorry, we put that money in the wrong account. That happens. So those are examples of information the bank doesn't know, right? The bank doesn't know checks that are outstanding or checks that are in transit. Balance per book. So our accounting records. Some examples of things that we might not know are interest income. You know how we have to book an adjusting journal entry for interest income? Well, if we forget to book that, the bank gives us the interest income, right? It deposits it into our account, let's say at the end of the month or at the end of the year, but we might not have recorded that. So we'd say, why do we have more cash in the bank than we have in our book? And that, oh, it's because they gave us interest and we didn't record the interest. Service charges. Banks charge you whatever, $5 or $10 a month to bank with them. If you don't record the service charges, the bank takes the cash out of your account, you're going to have a difference, right? NSF checks, non-sufficient fund checks. So how an NSF check works is if you write a check for $1,000 and someone goes to cash it and your account only has $800 in it, you can't cash the check. There's no partial cashing. Now the thing is the bank then has to reprocess that check, and it's a hassle for them and it's a nuisance, so they charge you like $40. So they say you wrote a check that was no good, and so not only did you not have enough money to pay the check, but we're going to take some money from you, $40. So if that happens, there's an NSF, non-sufficient funds fee that you get charged, that again, you might not be recording, but the bank's recording it. And then there's the potential for errors, right? That happens. Either way, there is one true correct balance of cash, right? That's a factual number. It's not an estimate. It's just how we understand the difference between what we're seeing on our books and what we're seeing in the bank account. Okay, we've been talking for a while. Why don't we take a quick break and come back in 10 minutes at 8 o'clock, okay?